afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, 3 ways to generate income with options will cover our material as well as your questions in a quick 60-minute session. Our presenter today is Bo Nobel, an OIC instructor representing NASDAQ. Bo started his financial career with the American Stock Exchange in 1981 and has served as a securities industry arbitrator since 1987 and as a securities mediator since 1992. And now, ladies and gentlemen, Bo Nobel will bring you our topic today, 3 ways to generate income with options. Bo?
Hey everyone, thanks for joining us. On behalf of the OIC and NASDAQ and the other 6 exchanges in the country, we welcome you and thank you again. So let's get started. 3 ways to generate income. My web is acting a little slow, but let's get some of the housekeeping out of the way first, guys. Some of the things we're not going to cover today is we're not going to cover the cost of trading. We're not going to cover the cost of professionals that take to account for or manage this. We're going to cover specific numbers, values, mathematics, and the rest of the values should be considered but not added today. This is expressed in a handbook that you'll get at any seminar talking about options and their risks. I encourage you to take a look at it or call the OIC if you choose to get your own copy. So here we go. Who we are. We are the OIC. The OIC is part of the OCC, that is the Options Clearing Corporation. It is a fungible clearing corporation that allows you to trade options on any floor at any exchange without having to designate. You will get the best price, the nationally listed best price, and this will be matched and cleared through an organization, the OCC. The OCC is owned by the exchanges, and they also fund the OIC, the Options Industry Council. It is the largest free database of options information, I believe, in the world. Don't hold me to that, though. These are the exchanges that you can see are national exchanges, and these are the people that fund our libraries and our webinars and our seminars. Okay, guys, we're going to talk about volume for a second, and this, I think, has to do with some of the people that were in the markets years back. And options may not have been the fairest of markets. They were always considered legal, and when I say fair, I just mean that the volume didn't allow for the liquidity. As you can see in the last decade or so, last 15 years, this has changed. We trade 17 to 20 million options a day. Liquidity is not a factor anymore. So if you are in, I encourage you to look at open interest just to make sure that there is liquidity in the option series that you choose, but to know that the marketplace, as a rule, in the 21st century is a very liquid, very, very manageable place to invest and to do your business. What we're going to cover today here, though, is a pretty basic seminar, and the outline is going to be covered calls. There's going to be an overview, a definition. We're going to talk about some specifics, a little bit of math. We're going to do some arithmetic here, addition and subtraction, nothing a little higher than that. We're going to talk about the importance of having a plan and some very common misconceptions that I'm sure you've all heard and hope none believe. So let's get started, guys. So a covered call overview. The strategy has to be for moderately bullish or at least a sideways stock. If you are feeling that the stock is a little soft here, there are other strategies, but this is not the one to capture and to maximize your return. You're looking to increase your income in a stable market or a sideways stock, meaning that it's holding tough, it's not going down, but it really hasn't shown the appreciation, and you're not willing yet to give up on it. The profits are limited when the stocks rise because you're capping it off with a premium product that's a result of selling a call against your stock, either your portfolio stock or your position stock. Losses do occur when the stock goes down, but honestly, losses will occur regardless if it's a position stock or portfolio stock if the stock goes down. A covered call increases your yield and reduces your risk in position stock. So let's define it. The investor, and I use this term softly, simultaneously, but for sake of argument today, let's call it a simultaneous transaction, where they write or sell one or more equity contracts against one or more 100 shares of stock. So it will each be a one-for-one trade. The equivalent of stock has to equal the equivalent of options, but it can be done in a group against a group of portfolio stocks. If the stock is bought and call is written at the same time, you have a covered right or a buy right. They're both the same term. You may have heard them separately. They are interchangeable. If you already own the stock, this is a great term to use with a broker or a person in the trade. It is called to overwrite it. That is portfolio stock. So you have overwritten and written options. So why would you write a call? Let's maybe answer that in a couple of seconds. And what are the obligations? What do they cover? And what should your concerns be? So let's go through this one at a time. Your primary goal is to increase the return of your equity. The call premium received and kept is kept in the account, regardless of the outcome of where the stock falls. The premium is kept. You generate additional income over and above any guaranteed or promised dividends, which I use those terms softly also. So you have to have a forecast. It has to be neutral to bullish. It doesn't have to be bullish. It could be a sideways stock, and it works perfectly in that case, or to keep a stock that is going sideways and not to leave it, not to bail on it in your portfolio yet. So the call premiums, they limit the downside and limit the upside. And this is where I'm asking you to do a little mental math, and we'll get into the physical math in a couple of minutes. There is a term that you see reference to. It's called BEP. Now, it's a break-even point. What we're trying to do here is relative to the strike price, you have to add or subtract the premium from the strike. You will get a range where you will break even if the stock stays within that. Very, very imperative. I encourage you, every time you look at a call premium, you start to inherently add it to the strike and subtract it from the strike. You will immediately get a range where your investment will be secure. Like any call writer, short call position, he has the obligation to sell the underlying shares at the strike price agreed if assigned. So there are a lot of things going on there in order for you to have to become assigned on your position. It is a random assignment. It is generated through the Options Clearing Corporation, and you will be notified either through your account or through your brokerage account, and these are considerations that you should explore before you start to trade your first few options. Your assignment, meaning your obligation to deliver, can happen at any time, including at or before expiration. You will get that notice, and you will have to deliver that stock, 100 shares, from your account or pay for it. Equity options are American style, which means that they can be exercised from the second they are purchased to the moment they expire. So the third Friday of the month at 4 o'clock, at 4:10, your options expire. From the moment it is purchased in your account, it doesn't have to land in your account. It doesn't have to clear your account. You are entitled to exercise that option if you're the owner. In return for this obligation, the call writer receives and keeps the option premium. That is instrumental. You are selling the right to another party to purchase the stock at his or her discretion. You have sold that right. Now you have the obligation to deliver that if need be, if circumstances call for it. This will be done through your brokerage house, and clearly you do not have to run around the street looking for your 100 shares of stock. There is a formal process for this, and all brokerage houses are aware and capable of making this delivery. So your long stock, you have to understand, on the other side of your trade, your overwritten stock or your written option collateralizes the short sale. So you're not going to have to go to the marketplace to deliver this stock. It will be called from your account, and it will be delivered to the counterparty. So we do have an upside loss potential also of short calls, but that is also limited. Any upside loss is offset by the overwritten stock or the portfolio stock. So it is a closed loop that is guided by the range in which you can profit. So again, the profit sweet spot is the premium plus the strike. On the upside, the premium minus the strike on the downside. Those are the parameters you're looking to work within. Okay, next slide. So this is a graphic representation. This is a quadrant where it's positive, 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 negative. I think most of us are familiar with this. So where's the risk? The risk is, of course, going to be on the stock side. That is the unhedged position on the downside. So an upside stock profit potential is limited because it's capped by the premium added to the strike, which is your break-even point. Mathematically and theoretically, even subjectively, I think it should become more apparent as you start to think of these things as a range versus just an option. You have to attach it to the strike price to make it a stock-oriented vehicle. So anything else I want to talk about on this page? Where's the risk? Okay, we're good. It's in the long stock. So as we talked about, the upside profit is limited. So you have a strike price and you have the paid option, and here we're going to start to add these prices, get a sum, and we'll find where it is our break-even point on the upside. The downside loss potential, of course, could be substantial, but with any equity ownership, the downside could be substantial. You're not increasing your risk or you're not reducing your yield. You are, in fact, doing the opposite by trading this option against your portfolio or overwritten stock, by increasing yield and reducing risk. And you have to understand that if this was in your portfolio unhedged, it will experience the same loss as it were if it were hedged. So you're experiencing no more risk. I think that's very, very imperative. And I'm not trying to sell you snake oil here. I'm just trying to sell you a little math here, guys. So you own 100 shares of stock. It's trading at 52. You're neutral or moderately bullish on it. So that qualifies it qualifies for a buy rate. So you want to generate a bit more income, generate a bit more yield to this, and you have a target price. You have a plan in place. You have some kind of range in mind. So you sell a 90-day option, a 3-month option for 1 3/4, $175. So you get $175 more than you would have in your account if you were just depending on dividends or increase in price, material change in the stock. So this gives us a little bit of a graph to look at, or a chart to look at for those graphically declined. The 100 shares at 52, and you sell this thing. You sell the XYZ 55 at 1 3/4. So where are we? What happens at 52? Okay, nothing, really. So long stock is basically flat, and you get to keep your 1 3/4. So you've experienced a yield of $175 over and above your investment. That is quantifiable in a percentage term, and that we'll get to a little later. But right now, let's see what happens if it goes below. So you lose $2 on your stock, and you make 1 3/4 on your options. So effectively at 50, you lose a quarter. And you can go through the math. I'm not going to sit here and do arithmetic for you, but I think it's imperative that you're able to start to do this math in your head based on your break-even points and your range of stock. And you need to start to allow that to guide your choices going forward. Don't fight it if the stock is going in a direction against you. Use other strategies to manipulate your positions to ameliorate that loss. And we will cover, to say, a few today. So if you're starting to understand how these options work against stock, you'll start to understand increases and declines in your break-even point. This, again, is a positive-positive chart, positive-negative quadrant chart. And if you own 100 shares of stock and you sell one option at 1 3/4, you should be doing the math in your head, and the break-even point is going to be on the upside. It's going to be where? Anybody want to guess? Yes, that is the answer. 56 3/4. So on the upside at 56 3/4, the seller, the writer of the option, is going to start to plateau against the long stock, and your earnings start to or will plateau 100%. Your potential profit is your break-even point minus your stock, which is $475. You have sold your option $475 over the value of the stock, and that's your potential premium profit, $475. So if the stock is at 52, you sold the calls at 175. The 55 is at 175, which is 56 3/4. 52 minus 56 3/4 is 475. That is your potential maximum profit point. On the low side, if you subtract 175 from 52, you get 50 1/4. Below 50 1/4 is where you're going to start to lose money, which increases your loss range by the premium you have sold in the call. So you've extended your loss parameter $1.75, and you've raised your profit potential 4 3/4. So here we are. You can do the math and see if it benefits you to explore this. I'm getting to slide 18. So a covered call is an in-the-money versus, or should we do it in the money or out of the money? And this basically is more about protection and more about strategy than it is about anything else. And let's see how we're going to approach this. So writing an in-the-money covered call is a very defensive and a more conservative play. The way we can look at this also is by hedge ratio of options. So we know that both a call and a put, we're going to get a little into option theory, both a call and a put of the same option series, meaning a Jan 40 or a Ds 45, both the call and the put. Hedge ratio, if they're going to equal stock, has to equal 100. So if we're only using one of the hedge ratios, the call, the hedge ratio is going to be reduced. We know less than 100. So if we use a deeper in the money call and raise the hedge ratio, it always becomes more defensive and more conservative. So as we go deeper in the money with our buy rights, with our covered calls, we are becoming more defensive and more conservative. If that's your game plan, use it accordingly. Conversely, if we use an out of the money call and we start to become less sensitized to direction and more sensitized to return, then we have another strategy, which is exploiting premium return and selling hopes and dreams to people that choose to buy them. If your stock gets called away, you may make $8, $10, $11. It depends on the strike you're selling, but we know that it's out of the money. It is not a near-the-money option, probably $5, $6, maybe even $7 away from the strike price, the stock price. So that really will maximize our return in the event the stock drifts up or stays the same. So another covered call example. Let's look at another chart. So on July 31st, we have XYZ. It's trading at 43.5. The high is 49 and change, almost 50, and the low is 36 and small, almost 37. And I don't want to discount when I'm looking at the pennies on the stock range, but at this moment, we're just trying to mentally get ourselves into a range under a normal distribution and start to see if our choices about selecting this stock within its range makes sense. If it makes it a quantifiable good choice as opposed to a qualified good choice. So XYZ options. You have the OX 35, 40, 45s, and 50s. They're calls and puts. It's set up similar to an options chain, an options matrix available on nearly every analytic page from every brokerage house and optionseducation.org if you choose to use their non-trading vehicles, their non-trading models. So our forecast right here, it's XYZ. It's going to trade between 40 and 45 in the next 80 days. It could be analysts' work. It could be your subjective work. But that's really the premise that we're going to be trading from or investing from. So the action is buy 100 shares, buy some underlying at 43.5, and you want to sell an OC 45 at 230. Okay, so you should start to be doing a little bit of math in your head. The OC 45s at 230 is 47.30, quite a bit over the price of the stock, almost 10%. So let's see if it's a good trade or not. So it's trading 43.5. Your position is long and underlying, long 100 shares, and short one call against it. The option expired in 80 days, and it pays an 18-cent dividend. You should be thinking, do you get that dividend or do you pay that dividend? You should understand dividends. You should understand how it affects your stock. You should understand how it affects your options. In this case, the stock will trade down 18 cents on expiration date. The puts will go up a proration, and the calls will go down their proration. That's how options work. And you will have a check in the mail for 18 cents. So the stock portion is flat. Your calls will go down that you're short, so you may make a couple of extra cents on that trade. If you don't understand that, you can sit in front of an option model calculator, change the dividend, and see how it affects your option prices. I think that's quite a valuable few minutes you can spend at optioneducation.org. So covered call. So let's look at a graph again. You're long 100 shares. You're long the underlying at 43.5. You're short one of the calls at 230. Basically, your break-even point in your math is going to be what? And you should be doing the math in your head. Anyone? 47.30. Right? So that's where the plateau sees. That's why you see the plateau. That is your highest break-even point. What's the maximum profit? So you have 47.80 minus 43.50. There it is. It's 380. They're doing the math for me. So it's 47.30. 47.30 minus 43.50 is 380. So I'm sorry that I'm not doing the arithmetic for you that well, guys, but I don't have a piece of paper to pencil out, which is I scold my attendees at my lectures not to do my classes without papers and pencils. So please, if it does help, I'm going to get one out so I don't make that mistake again, and I hope you join me on that. So let's look at the option graph and see where we are, the option chart, and see where we are at break-even points. If the stock drifts down, there's going to be a loss. Your security is going to, your equity is going to suffer a loss, regardless if it has a right against it or an override against it. We can figure the loss out doing some simple arithmetic. If you're inclined, please do, or save it for later and just hone up your math skills. It's going to be very important having some math sense going forward if you trade options. And on the upside, you're going to reap the reward of the $230 in premium, the increase in stock price, and your sweetest spot is going to be $3.80 return on your investment of $43.50. Interest rate return on that if you want, or we're going to see interest rate returns specifically as we go forward. And this is just a little bit of the formula to calculate your rate of return on investment. If you're so inclined, do so. If you're not, you can just count on a calculator to give you your rate of return. But for those that do want to dabble a little bit more in the mathematics of equity option investment, here it is. So this is a boilerplate for equity option return on investment for call sales. And you can keep it, you can take a picture of it, you can use it at your discretion. Move forward to 25, fill some of these numbers in. So the static worksheet, it's going to be something like this. And you have your 230. Again, as our first couple of slides mentioned, we're not going to talk about commissions. We're not going to talk about margin costs. What we are going to talk about here is some dividends, some income, some rate of returns, some of the harder numbers. So as we fill these in, we start to see some numbers populate, and we're going to get some very simple division going. We're going to get a rate of return times the amount of time we have this, which is 80 days, and we're going to get a 26% return on investment, which is pretty sound. I think in anyone's book, it's quite sound. In today's environment where I'm getting 0.5%, I think a lot about 26% return. So this is not snake oil sales. This is a true mathematics, true opportunities that lay before you with capping a little bit on your upside, really getting, I think, a fair play from that return on your downside, and a quite sound investment for people that have portfolio stock to overwrite, and even people that want to get into the market at a cheaper cost of entry, which would be the premium over parity, the premium that you get minus your stock sale. So that, again, would be considered your cost of entry as a benefit. So if your call is returned, this is what I call the Hail Mary of returns. So in the case that you're short your call against a long equity, and it's called early, you don't have to return your premium that you were entitled to as a short seller. So as the time progresses, and what we're doing is basically changing the calendar on our calculation, I believe that it's going to be the same calculation for all of the math except the time held for the long stock. So if you don't have to hold your stock and pay that other foregone interest, opportunity cost, or the true interest paid for to your brokerage firm, then you have a 41% rate of return. Now, I wouldn't count on this type of investment to knock on your door often, but every once in a while it happens, sometimes with dividends when options are exercised early for whatever reason. And there are just rewards for being knowledgeable in the market. Is it free money? Absolutely not. Is it earned money? 100%. So I think you're entitled to have this in your account if you've done the homework and the groundwork to lay before you. So let's talk about some planning as it slides back up. So in scenario one, what would you do if XYZ raises above 45 prior to expiration? And would you do nothing, wait to be assigned? Hopefully at expiration, your option finishes in the money, where the contra side would exercise his privilege of owning the stock, and you would be assigned, which would flatten the account out. That as option one. Would you buy the call back and keep the stock? That's something that you may choose to do. Or would you close the entire position by buying the call and selling the stock? Honestly, I did go through this a little bit, and I didn't think there was an option there that I liked. But let's just see what they do. Do nothing if you're willing to sell the stock. So I don't ever like doing nothing. I like actively being engaged with my account. I think doing nothing is making a decision to have the stock called. If you think the stock they're going to close at the strike, which we call pin strike, and the customer not knowing if they're going to exercise or not leaves you in a position where you don't know if you're going to be assigned or not. So Monday morning, you can own 100 shares of stock or not. If you want to live that life, fine, or not. I choose not to. So at expiration, there are particular circumstances where you may choose to buy that option back and sell your stock if it's not portfolio stock, or roll forward. You can buy that option back and sell the next month out, or the next time frame that you have, weekly, monthly, quarterly, yearly out, whatever your strategy is. But I would never close the entire position by buying the call back and selling the stock. The only time I would do that is I'm absolutely feared that the stock is going to trade at the strike without exception, and that there is no way of knowing the market's position or mentality on what my position is going to come in Monday. No matter what, you can always roll forward, or you can roll down or roll up diagonally. There are many other considerations other than using two trades to get out of an expiring position. So what would you do? You buy back, here we go. What would you do if XYZ closed above 45? At that point, would you buy back the call and keep the stock? Nah, buying back the call, it really doesn't do anything. You buy back the call if you're bullish on the stock, and that leaves your position unhedged. At that point, you no longer have a buy right, no longer have a covered call, and you're an equity owner, which is fine. But as far as buying back the call and keeping the stock, that is not an option position or an option strategy in any case. Okay, C, close the entire position by buying the call and selling the stock. Close the entire position if you are bearish and willing to sell the stock. Clearly, when I said I would never do that, the only scenario that I would want to close the position and get out of it entirely is by leaving the stock in my rearview mirror. I'm not willing to hold that stock in a portfolio or even position hedged. So I would well agree with that if I have to amend my answer before. When should you choose between A, B, and C? Well, the markets can change, and you should have a plan. I am the biggest believer of a plan. There are option strategies that you should have in place and option and stock strategies you should have in place. So let's see if we can look at scenario 2. What should you do if XYZ is unchanged at 43 at expiration? Would you write into the call, sell the stock? And the truth is, there really is no objective answer. To this, every investor has to make a subjective decision on where they are looking forward today on whether that stock is a buy, a sell, a hold. And as you make these decisions, you make option strategies based on those decisions, and you effectively use options as a tool, not necessarily to maximize yield and minimize risk. Sometimes it's the other way. Sometimes it's to maximize risk. If that's in your strategy, maybe you're expecting a market condition to change or a material change of the stock. We can call dividends or announcements by the stock material changes. So there are many strategies that you would use, but they have to be thought of as a change in the material ownership of your stock versus a portfolio stock, gleaning dividends, gleaning right-hand move, an upward move in the markets. So again, be subjectively objective. If you want to write me about that answer, you can call the help desk and they'll get me that comment. Subjectively objective. I didn't mean that. So what should you do if XYZ begins to decline sharply? Other than scream at your wife or your golf partners for getting you into this, which they did not do, or doing anything rash, which is not doing anything at all, the deer in the headlights, there are many options. You can roll down. You can write another strike and get a little bit more premium into your option bed, into your yield bed. You can hold the stock and clearly make a choice to tighten up in your soul and believe in your convictions, or you can buy the call back and sell the stock. You know, that's basically what's going to happen. But if you believe there's a decline imminent, I think that you should have a stop-loss order in effect. This just popped up on the screen. So as I'm stalling a little bit to get to 33, I think you should start with a plan. I firmly believe that. You should start with a little bit of cash. You're buying some underlying assets, either for portfolio stock for children or yourself or retirement, whatever the excuse du jour is. I think it's a fantastic excuse, buying into America. I think you should find a stock. You should forecast it either neutral or bullish. I believe that a stock should be something that you understand and not that is understood for you. I think you should invest in things that you believe in, that you buy, that you use, and most importantly, things that change your life to the better. I think that there are new stocks and new companies that are issuing stock daily. I think reading trade magazines, I think being up in your own industry is the most telling way to see these new technologies coming about. I'm doing everything I can to not use the word where things are changed dramatically as a result of new technology, but I'm not going to dance around that. But what we want you to do is look at a stock, not love the stock, but like the stock, like what it does, like the service it provides to its customers and to its shareholders, and maybe sell a call against it. And this is what I'm saying. It doesn't have to be necessarily simultaneous. It can be something done over the course of a short period of time or as a strategy to do, but you start to look at in the call options, out of the money call options, out of the money call options, and at the money call options. And as you start to look at those types of options, those degree of hedge ratio options, you can start to devise a plan where you're going to minimally hedge your stock or effectively and aggressively hedge your stock. And this is how you start to look at strikes. And this is how you start to divide the board up in terms of strategies. And then you look at terms and times that you are making these decisions for, and then you look at effective expiration times. And between these two jostling ideas, you have expiration and strike prices. And then you get to pick where and when on that board you can most maximize your profits and your returns. So the plan has to be willing to sell the stock at a certain price. Don't marry the stock. Don't fall in love with the stock. Ultimately, you'll wind up with cash again to like another stock that changes your life. Have a stop-loss point. Put a stock price in where you think that stock is effectively either going to start to plateau or effectively start to go back down. All securities are elastic, so you have to start to see boundaries and see ranges, and then don't bet against them, but use them to guide your financial decisions. We encourage you to diversify. If you like a certain type of stock or a certain class or group of stock, that's wonderful. But like all adages, there has to be a degree of truth. Don't put all your eggs in one basket. Conversely, if you work for a company and you've been working there many years and you're wholly concentrated in a company stock, there are option strategies to help you minimize that concentration of exposure and diversify out of that field if you want to. And these are explorations you can make once you start to understand option theory and option application. You should be looking to do it again and again to a degree. I think most people are capable of keeping a certain number of stocks in their portfolio, understanding what those stocks do and how they are effectively working for them and for their customers and their equity shareholders. So I leave you with the understanding that you can only remember 7 phone numbers, 7 numbers at a time for a phone number. So that might be a guiding direction. I wouldn't use many stocks in my portfolio against options or many stocks in my portfolio that it becomes cumbersome. You want to be the master of this and not the jack of all trades. So misconceptions about covered calls. Let's just start to talk about how all options go out worthless, I'm sure. So the reality, being assigned is bad. Being assigned is good, especially if you are being assigned before the term of your expiration. You're increasing your yield. That's always good. What you can always do is go to the marketplace and sell another option. There are strategies where if you have a buy right on and get assigned and your account goes flat, meaning it has no position, you can effectively sell a put. The put will act as a synthetic buy right. If you get put to stock, you sell a call against it over time, effectively rolling this strategy on and on infinitum. So is assignment bad? No. Covered call is good because most options expire out of the money and worthless. No. Mathematically, most can't expire out of the money or worthless. They can't. They can only half expire out of the money and half are puts and calls. So mathematically, only 25% expire out of the money or worthless. So here we are. To outperform a sideways market, covered calls are fantastic. If you have a stock that's going sideways, I don't want to name any, but there are many, many very entrenched stocks, technology stocks, that have moved just a few dollars in the bold moves that we've had both up and down. To capture a yield from those types of stocks is being a market guru, not being a person that's running around with like Chicken Little, scared that their stock isn't moving. You've committed to the stock. You've made a commitment to the stock. You're not giving up on your stock, but you need a bit more yield, so the option will provide that. To sell it at a target price and generate additional income truly is a plan. Now, you have to please stick to that plan. It could be a moving plan, but it can't be a plan that occurs to you like at the moment. That's going to be guided by greed and fear. Those are the two strongest influences on Wall Street that you have to start to make accommodations for in your own personality. Okay, covered call writing forces you to sell winners and keep losers. Honestly, I've never heard that. I saw this in the slide presentation, but I really never heard that. There is no selling winners. You can roll strategies. If the call gets assigned and your stock gets called away, you can sell a put or reestablish your option position and reestablish your stock position. We trade about 4.5 billion shares of stock a day. We trade about 17 million shares of stock a day. I honestly think we can make a room for any customer trade in those figures, and I mean that sincerely, guys. So investing requires active management. By definition, option traders are active traders. When I say by definition, it is in agreements that you sign. It doesn't mean you're signing an agreement that you have to trade a certain amount. It just means that it's not a buy and hold strategy like equities. It expires. Time decay, which is involved in every value of every option, is a marching loss. Every day it loses money. So there is volatility every day, nearly every day, unless there's a material change, loses money. These are not investments that are to be held or looked at in your account and wished something happens with them. They are actively traded and usually hedged against in order to preserve the specific values they have. There's sensitivities, let's call them. There's specific sensitivities. And if you're short a call and you're assigned, you can repurchase, like I said, the stock. If you're bullish, the market's very, very liquid, very, very thick these days. It might be the plan, the ultimate plan of the divine intervention that was called away. Fine. If you're superstitious or you're religious in that nature, let that be your belief system. If you're mathematical in nature, you can go to the marketplace, get the best value for your investment, do your stock at the best value, sell your call at the best value, and reestablish a position. So in misconception number 4, the larger the premium, the better. As a rule, yeah, within reason. If there's a material reason why there's a huge premium, then you're selling a huge risk. There's a huge reward to that. The market's efficient. It is giving you guidance that you are entering a watch-out zone, falling rock zone. I've been through them. I've climbed rocks. I've climbed mountains. And I've been safe my whole life with the right tools and the right ability to see the dangers. And you have the tools to do that. So it's not a place you shouldn't go. It's a place you should tread very, very carefully. The rewards are magnificent. Covered call summary, the strategy is appropriate for neutral or bullish, meaning 65, 68% of the marketplace, almost 70% of the range is affected here. And you can safely trade within a standard deviation within 68% of all changes that occur from the mean safely. So it's a pretty safe haven to work within with attention and with the proper tools and understanding. Profits are limited, but the rewards are there. So are the risks limited. There are unique trade-offs. Use them to your benefit. Will losses occur? The answer is yeah, but losses will occur whether or not you introduce options into your account. The stock will experience the same loss or more by not introducing these options. So if you have some, I know I made reference to this stuff, guys, and I do want to leave this up on the screen for a couple of seconds. OptionEducation.org truly is a compendium of models and definitions that will answer nearly any question you have. Explore it, exploit it. It's free. They are really geared towards helping you out of a bind with your position, I believe, but they are there to help you regardless. They are there to give you clarity and definition, give you direction, and use that. Use them. There's a mobile app. There's an OIC YouTube channel I have not explored personally. I'm sure they're just as good as all their other resources, which to me is fantastic. So I hope we have a couple of seconds to answer some questions. I don't see anything popping up. I hope I didn't go too far afield today, but I will invite our moderator back in and see where we are with the session, please.
Bo, thanks so much for all your time and expertise. And we do have a number of questions to get to, but before we do get to those, I do want to remind our listeners that if we are unable to get to your questions, or if you have further questions about some of the ideas and concepts that we've discussed today, you can always contact that investor services team that Bo referenced at options@theocc.com. That's options@theocc.com. They're ready to help answer questions about option strategies or positions, and you can always check out that OIC YouTube channel that Bo mentioned, so you can review a number of options, strategies, and concepts at your own pace. And with that, Bo, let's get to some of these questions. The first one came in at least twice. What's the difference between being long a call and being short a put?
Well, mathematically, they're quite the same. So let's skip to a definition. They both yield a hedge ratio, which would be positive. They reflect long stock. The most inherent difference is risk. You are selling the privilege of exercising. Regardless of what it is, a long option can never, ever be taken away as far as the privilege of the exercise. So you always have that right that goes with the long holder position. I don't want to keep harping on that, but this is a basic course. And being short a put, again, yields a positive delta, we're called hedge ratio to stock, but effectively sold or sells the right that is enjoyed by the long call holder. Okay, that was a 2-minute answer for a very, very simple question. Let's see if I can get those a little shorter.
Bo, we had a couple questions about earnings season. Would it be, in your opinion, a good idea to hold those covered calls through earnings season, or should you plan your covered call trades to expire before that earnings season hits?
Great question. Now, you're asking about material changes to a stock that really very few people know the answer to, and the ones that do are, by law, shielded from sharing it. So it is a question that you subjectively have to make, and you base it on stock performance, you base it on some of the numbers, on some of the analyst reports. You have to build a little gold mine, go in there with a little axe, a little pick shovel, and dig, ting, and you're constantly mining for information. There's very, very few surprises when it comes to earnings. And my feeling is, if you like your stock and you're on board, you got to ride that horse to the end. If you're feeling a little uncomfortable about it, one very, very small trade will get you out, because remember that options are synthetic stock, short calls and long puts. When you combine them into a combo, it makes stock. So if you're short a call and you're going into earnings season and you're long stock against it, all you have to do is buy a put. That's all you have to do, and you are out. You have a position in your account, but you are neutral, hedged. The world can end or the world can be reclaimed tomorrow. Nothing matters. You are fully hedged to the number, to the cent. So if you're concerned, finish off your combination, finish off your hedge, which is effectively why buy rates yield the return they do. It's because effectively you are synthetically short the put against your long stock. You get to keep that premium, or if you choose to invest it. You can make a vertical out of it. You can make a diagonal out of it. You can make a calendar spread out of it. You can materially change your stock position into an equity option vertical position. Although it looks like you have stock in your account, you are fully hedged. Now, that's option theory graduate school, so I hope I didn't drown everybody with that tidal wave of information.
But let's take it down to Options 101 on this one. We had a number of first-time attendees on our call today, and some of the people would like to know what guidelines you would give for the ideal characteristics for an underlying stock on a covered call strategy. Would you look at volatility? Would you look at large cap? Would you look at predicted price? What kind of ideas would you look for when you're trying to make this covered call?
Okay. So firstly, like we talked about in the seminar, there's overwriting, which is portfolio stock that's already invested in, that's in your account, and you're trying to maximize its yield and minimize its directional risk. That is one particular way the stock's already been found. You have a gold mine of these securities already in your account that need attention. Now, if you want to enter into the marketplace with a new stock, with a purchase stock, you can sell a call against it. I believe it has to be a sound stock. I believe it has to be something, of course, that's listed with options. You have to believe that it's servicing a need and it's providing a common good to both its customers and to its equity shareholders. And I would say most mid-cap to large-cap stocks fit that requirement. I would look at the open interest to make sure you're not setting yourself up to get into a pot of boiling water where you can't get out of these things. But most, if not all, equity options that are traded these days are liquid. If you've heard of the stock, it's liquid enough for you to get in as a customer and out within a margin of theoretical value. It's called its effective spread, the 1 to 110 or $1 to $1.25 is the effective spread. So it's very, very small effective spread on any mid to large cap stock. And by selling the option against it, you're reducing your entry cost. So you're beating the market by dollars sometimes, and usually $1 or $2. So the cost of entry is far below in percentage terms and in nominal terms, in dollar terms, far above what the regular investor is going to do. So in every aspect, I think almost every stock qualifies if you have a sense of confidence in it.
Bo, what would be the benefit of buying an in-the-money call if you can just buy the stock at a certain price?
There is no benefit. It's a mathematical equation. So if you can buy the stock and you have to carry the stock for a term, whatever your strategy is, whatever your term is, there's going to be either an opportunity cost to the money that you've taken out of your account to buy it or the money that you're borrowing to buy it. That is a fixed cost. That is the cost of carry. Now, if that cost of carry equals the option, then you have to buy the option long term. And we have leaps. They're 1 and 2 year options and sometimes further out. These very long-term options can replace your stock, and that's a strategy called stock replacement. And then you use that stock as your equity base and sell options in the expiration term that you choose, weeklies, monthlies, quarterlies, and half-yearlies, at 1 at a time, of course, not 17 at a time. And then you can roll your premium forward as the months go out, 1 at a time, to match your leap. And then you roll your leap out. So stock replacement is quite a sound investment, and there is no difference mathematically.
Bo, is there a good way to time a covered call if you want to bring in premium but not lose the underlying?
Great question, and I've got a great answer. Now, I don't want to keep harping on the OIC they're not the panacea to end all panaceas because you can't trade, and they're not meant to trade on their models. But they have effective models where you can start to paper trade and start to look at the dynamic relationships between these equity options. So can you repeat the question, and I'm going to get right to the point. I'm sorry.
How can you time a covered call if you want to bring in premium but not lose the stock?
Okay, and I lost my train of thought there for a second, but here we are. So you have this option model machine, this option model calculator. It's the effect of the Black-Scholes and the Cox-Rubinstein model differential equations. They give you this modeling machine where you can put in the variables, change them any one at a time, and you get an option value. My thought would be to keep the 5 stock, strike, volatility, and interest rate static and change the date of the expiration and see where the decay maximizes. Option decay is not linear at all. So it hits a cliff and falls off at a certain time. You can start to predict this time quantitatively, mathematically, by changing the effective date of expiration, not of expiration, but of the purchase price, or where that option will be at a certain date. These are quantified analytical tools at your disposal, free. So yes, you can start to look at option days and dates in terms of the best time to sell your option, in terms of beating the curve and beating the decay, because there is a time parameter where that decay literally falls off a cliff. It used to be, and the greatest answer I used to get was 10 to 11 days out. If you ask any seasoned synthetic put seller or buy writer, they'd say, 10 to 15 days. And they're right. But you don't have to hold that, and you don't have to miss it by 2 days either. You can start to look at it, quantify it, and effectively trade mathematically and soundly. All right. Another 4-minute answer to a 2-second question.
Fair enough. Bo, this might be one of those questions where the answer really depends on what the investor is trying to accomplish, but would it be better in certain scenarios to buy leap puts for long-term covered call selling, or would it be better to buy a front month put each month?
Effectively what you're doing is rolling. You're rolling your conversion forward. So if you're long stock and you're trying to buy puts in order to sell calls against them, you're creating combos either by strike or by expiration. So you're effectively making time spreads or verticals. So when you say that, is it better to buy the near-term put to sell the near-term call against it? All you're doing is creating synthetic stock against your long stock, and you're going to have to leg in and out of that position in order to make money. But if you buy a long-term put against your portfolio stock and you overwrite the calls month to month, you are reaping the benefits of the stock if it stays close to the strike. Now remember, when you're selling premium is widest at the strike. As stocks move towards the strike, they gain premium, gain gamma. And the trick is to sell that gamma clearly at the right time and at the right strike. So if your stock is trading sideways, you buy a long-term leap and get to sell 6 to 8 to 12 to 18 months of premium against that position. That is a home run. If you're in it for a shorter term and you're just looking to reap some real short-term benefit against premium benefit against a short-term investment, you can buy a near-term put and sell any call on the board, effectively creating either a time spread, calendar spread, or a diagonal spread.
Bo, we're just at our 60-minute mark here, but I think we have time for just one last question. And I guess it's a simple one. It's a short question, but it might have a long answer. Can you ever make a long option?
I haven't had any of those today.
You've had a number. Can you ever make a long option into a short option?
Great question. No. You can never change the polarity of an atom. You can never change the polarity. You can never change if an element is a positive. It can't change. Now, some quark physics or some quantum application might prove me wrong, but just understand that if an option is long and you start to trade around it with stock, you are effectively creating what are going to be called another foundation called synthetics. So you can, if you take a second, everybody can write this down for a second. Long stock equals a call minus a put plus the strike price. Now, algebraically, you can move that formula around to solve for any synthetic option, just to move it to the other side of the equation. So here you have synthetic options. You have types of investments that you're going to have to start to localize and start to really, really effectively use. So if you're long a call and you sell 100 shares of stock against it, effectively you're creating a synthetic put. That put is going to be long because you started with a long call. It can never be anything but long. It may represent short hedge ratio, short stock, but effectively the call is always going to be, and the option is always going to be the same polarity it started.
Bo, thank you for all that time and expertise. Do you have any closing thoughts for our listeners today?
I do. I really encourage you guys to start slowly. Start with portfolio stocks, start to overwrite an option. With that, start to see how it fundamentally changes the dynamic of your investment. It becomes an equity option. It becomes a short put. Trade that short put as a put. You can buy puts against it. You can buy calls against it. You can trade stock against it. But effectively, you have to understand the synthetic nature of options and what you're doing to your equity position once you introduce equity options to them. That is fundamental. It is imperative, and it is very, very, very strongly recommended that you do not start to trade options in any other way except portfolio stock unless you start to understand these very, very fundamental synthetic relationships, dynamic synthetic relationships.
Bo, thank you so much today, and ladies and gentlemen, thank you for your time as well. We had quite a few questions come through, and we were not able to get to all of them, but as I mentioned, we do have our investor services team ready to help. Feel free to reach out to them at options@theocc.com. And you can always check out that OIC YouTube channel. You can review a number of options strategies at your own pace and learn at your own speed. Many of you also asked about further education, and Bo mentioned it as well. Please visit optionseducation.org, the OIC's website, and check the Getting Started section for further reading. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.